The Fed just pulled a classic head fake on mortgage borrowers. When everybody was celebrating this week quarter point rate cut, mortgage rates actually jumped higher, hitting their highest levels in 2 weeks. If you're scratching your head wondering how the Fed cuts rates but your mortgage quote went up, this week's analysis will blow your mind and save you thousands of dollars. Let me break it down exactly what happened to mortgage rates this week. We started Monday with 30-year fixed rates around 6.25%. And by Friday, we ended at 6.37%. That's right, rates went up despite the Fed cutting their benchmark rate. For those of you tracking DSCR loan rates for investment properties, we are looking at approximately 7.25 to 8.25 this week, which is about 1 percentage point higher than conventional mortgages. The best rates are going to investors with strong debt service coverage ratios above 1.25%. So keep that in mind as we dive into what moved the market. 3 major economic events shaped this week's interest rate environment, and understanding this will help you make smarter financial decisions going forward. First, let's talk about what I'm calling the Fed rate cut paradox, the market's ultimate curveball that caught most borrowers off guard. The Federal Reserve delivered its widely expected 25 basis point rate cut on Wednesday. But here's the kicker. Mortgage rates surged higher immediately after the announcement. This is classic September deja vu, and it reminds us that mortgage rates had already priced in the Fed's move weeks ahead. When you see rates drop before the Fed meeting, the market is often buying the rumor and selling the news, meaning the good news was already baked into the pricing. For the housing market, this means smart borrowers who locked rates before the Fed meeting came out ahead, while those waiting for post-meeting drops got burned with higher quotes. The second major factor moving rates was August's inflation report, which came in at 2.9% year over year. Now, this wasn't dramatically higher than expected, but it stayed stubbornly above the Fed 2% target, and that gave bond investors a pause. Core services prices, that is the sticky stuff like housing costs and services, remained elevated, reinforcing concerns that the Fed's inflation fight isn't completely over. From a real estate investing perspective, persistent inflation in housing costs actually benefits rental property owners through the potential for higher rent, but it makes financing more expensive in the short term. The third economic bombshell came from the Bureau of Labor Statistics, which dropped a massive revision showing the economy created nearly 1 million fewer jobs than initially reported in the 12 months prior to March 2025. This huge downward revision initially pushed rates lower early in the week as investors worried about economic weakness. But the Fed's measured response kept any additional rate cuts modest. For DSCR investors, softer job markets can actually mean more rental demand as fewer people can afford to buy homes, creating a potential tailwind for cash flow. Now let's talk strategy, because timing matters in this business. For home buyers, this week proved that timing the Fed is a fool's errand. The best strategy remains locking when you find a rate you can live with, rather than trying to guess market's timing. For DSCR investors working with rates in that 7.25 to 8.25 rate, focus on properties with strong cash flow potential. A debt service coverage ratio above 1.3 not only gets you better rates, but also provides a cushion against vacancy or expense increases. Here is a creative financing insight that might help some of you. Consider adjustable rate DSCR products if you plan to refinance within 5 to 7 years. Some lenders are offering SOFR-based ARMs starting at 0.5 to 0.75% below fixed rates, which could improve your initial cash flow significantly. Even with this week's rate volatility, I want to keep the bigger picture in perspective. We're still near 3-year lows compared to where we were in 2023 and 2024. For investors, this is still a window of opportunity. The key is focusing on cash flow properties and building equity while rates eventually normalize lower. Remember, you can always refinance when rates improve, but you can't buy that perfect investment properties twice. So here is the week in summary. Despite the Fed rate cuts, mortgage rates moved higher due to already priced expectations and lingering inflation concerns. This reminds us that timing the market is nearly impossible, making solid investment fundamentals and strategic rate locking more important than ever. And just like that, this is already all news. Thanks for watching. If you found this video helpful, give it a like and subscribe for more expert insights on real estate investing. But wait, if you're still scratching your head about how the Fed can cut rates while your mortgage quote goes up, I have got the perfect follow-up for you. Click right here to watch my deep dive video, Fed cut rates. So why are mortgage rates more expensive? Where I break down exactly why this happens and how you can use this knowledge to your advantage as an investor. If you are ready to take the next step or have questions, call or text me at 914-334-0920. I'm here to help you understand the market, find smarter options, and turn today's challenges into tomorrow's cash flow. Bye.